Before we get into a full-blown net present value calculation, one of the more advanced ones, I thought it'd be better that I do a highlight or an overview first, and then we can do an example, because there's quite a few moving parts that you want to consider. So the way I like to break it down is as follows. I want to look at the cash impact of an item, and then look at the time of that impact, because that'll determine how you bring it back to today's value, and then the description of the item. So the first one would be the cost of the asset, because every investment or project is going to have that. The time is now. You make that up front, and the cash impact will be negative. Okay, it's a cash outflow. The second thing is the initial working capital required. And this would be things like you're starting a business and maybe it's a store. You're going to have to go buy a whole bunch of inventory. So that will be done now, and it will need to be in place before your store opens. So it's also a negative cash impact. So that's an example of the working capital. There's other stuff that could be used as well. The other things is once the project is up and running, you hope to generate some cash flows from it. So the after-tax cash inflows. And these would be per year normally. So these would be in the future, and this would be positive. Okay, so you'd expect it to continue to grow or continue to occur for many years. And then there's the CCA tax savings. So the savings you're going to get for getting the deduction for buying the asset, and these occur in the future as you depreciate it. And since it's a savings, it's a positive cash flow as well. And then if you're able to sell the asset at the end, you could get a salvage value. And that occurs in the future as well and is a positive. And the very last thing is called the recovery of working capital. And this will be the same as the inventory at the beginning. I don't want to overcomplicate it, but basically assume that the inventory you bought at the very beginning before you opened the store, you sold the last item on the last day. So you got all of that back. So that would be a positive cash flow, and that would be in the future. So how do we present value all of these? So these are already, there's no PV required, okay, because it's in today's dollars. Okay, so you don't have to do any adjustment for this, and it's nice and simple. The present value of an after-tax cash flow is the PV of an annuity formula, so the ordinary annuity. The present value of the CCA tax savings, this is the PV of the CCA formula. That was the big formula that we just did in the previous video. The present value of the salvage value and the present value of the recovery and working capital is like the present value of a lump sum. Okay. So some of these you're going to have to adjust, some you're not going to. You just want to make sure you break each separately down, and then you add or subtract. When you've summed up all of those cash flows, you will have the revised, more complicated net present value.